Can't you hear the sound that's in the air? It's rock and roll. 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 It's rock and roll.
And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show, presented by RIA Advisors.
And good morning. Welcome to Financial Fitness Friday. It is something completely different. Lance isn't here. He's in an undisclosed location. Already written 10,000 words. I'm Rich Rosso, CFP. Here with Danny Ratliff, CFP. So happy you're here. I've gotten a lot of good advice already this morning. One from Facebook that I need to look more like Ryan Gosling. Why? I have no idea. Facebook has a suggestion for you. Look more like Ryan Gosling. I mean, I like him, but why must I look like him?
Did you already tell him you were the Iron Man? I mean,
no, like, I could look like Johnny Depp. Why Ryan Gosling?
You'll need extensions to pull off that ponytail.
There's a pun in there somewhere.
Yes.
Couple tattoos.
A couple of tattoos. I need to speak
Piercings.
with 5 to 6 seconds between my words. Thank you. Well, we're glad you're here. And yesterday, thank you for those who turned out for our Medicare Lunch and Learn. We had a really good turnout. Lots of pitfalls that you need to understand. But heck, that's what finances are, right? Lots of pitfalls that you need to avoid. So we went through that rather thoroughly yesterday, Danny.
Yeah, it's an in-depth conversation. It's also going to be up on our YouTube channel for a bit, so go check it out. Look up
great.
Real Investment Advice, or Real Investment Show, actually, and you can go subscribe, go like it. We'd love to see you there. And, if you have questions, don't hesitate. You can go ask questions, realinvestmentadvice.com. Go to ask a question, because I know this is typically one of the bigger events that people struggle with, in the sense of, when do you file? What's the timing look like? What does it look like if you're still working or a spouse is still working? Do you actually have to file for Part A, Part B, Part D?
Yeah.
And then if you don't, if you mess it up, what's the penalty? I mean, these are permanent penalties, Rich.
I know. And it's so easy to mess it up. In all fairness to just everybody who tries to research this. Danny and I spent a lot of time in the weeds with it, but we're like going, my gosh, no wonder so many people mess this up. Now, when it's up on YouTube, you may be too a youngin' and not ready for Medicare, but you probably have parents, maybe grandparents that are needing this information. Please pass that on to them. It's very educational, moves quickly, and of course, we are here for any questions.
Hey, it may help protect your inheritance.
Yeah, because less to penalties, more to you. Oh, I like that. Less to penalties and more to you.
The other aspect of that, Rich, is that so many times we find that people don't actually shop it once they're on. I mean, they may get all the rest of it right, but then once they're there, they just say, well, this has been great. No need to change, but these plans do change annually. And especially when you start talking about Part D, that prescription drug coverage, that can be something that, you want to make sure that you're doing right, that you don't have a drug that's not covered any longer.
Right.
But Lots of money left on the table. Make sure you're shopping if you're on it. Open enrollment. This is your time to shine. Save some bucks.
It is, especially if you're on Medicare Advantage. But no matter what, you should be shopping your Part D coverage every year. A lot of older Americans leave money on the table, and with inflation the way it is, you cannot afford to do that overall. So obviously the 5-year Treasury hit 3%, Danny. Mr. Powell came out yesterday. He was really stern. Inflation is important to tackle. And of course, the markets didn't like that. And I wonder, because he was talking about front loading these interest rate hikes. But what I wonder is, are we going to be looking at 75 basis point increases here maybe over the next couple of meetings? What do you think?
Well, that's one thing that a couple of Fed officials have come out and they've actually talked about raising it 75 basis points. And yesterday, Powell's at IMF and he says, hey, we're talking about a 50 basis point hike, which is interesting to me that the market responded the way it did, considering that we knew this was likely going to happen. I mean, actually, the 50 basis point hike was priced in back last month.
Yeah, and that's why I think maybe we're pricing in, maybe the market, based on some of that stern language, is pricing in more of, hey, one, he's actually serious, even though my house is literally burned to the foundation. He's going to do it this time. But maybe, just maybe, he moves faster on the 50 basis points, or maybe we start to price in 75 basis increases. One thing we do know, Danny, he is way, way, way behind the curve. And soft landing, just the talk of soft landing is absolutely ridiculous for the economy because we know where we're headed. It seems like he is much more focused on tackling inflation. I thought with the IMF, he was sort of serious about it. He seemed like it was really concerning him. Like maybe he was up all night for one night during the week. So it felt like he was really there. So though obviously that did spook the markets. We were on a nice move here. Markets were oversold, so we did get a nice bounce. And then, of course, now we started to lose that. So I think it was the rough language, Danny. We'll see how it progresses. Futures are down this morning. Not much. They were down worse earlier, about 60 points on the Dow. And it was the typical move yesterday of what worked and what didn't.
Well, we're beginning to hear the rumblings of a lot of different analysts and economists are beginning to say, hey, we may beat actually peak inflation. So this is going to be interesting to see if we do start to begin to get softer and softer data, which is what we have been expecting over time. What does that look like? And then how does that change the course, especially if this does at some point begin to cause some market instability? We're already seeing a lot of different areas that are beginning to slow. We looked at mortgage applications. I mean, this just makes common sense, right? You could get a 30-year mortgage for 3.5 for the longest time, and now it's at 5.3 or more.
I've seen higher.
Yeah,
I haven't seen higher. I've seen some rates hitting 6 on 30-year, depending on where you go. And I'm like, whoa. Historically, that's low, but for this generation, that's a killer.
Well, I think that's going to be the key, right? Where does it start to really impact housing prices and then begin to make its way to other asset classes?
You're going to see, I think, homeowners. It's called endowment bias. But my home is better than your home, Danny. So I'm going to get more money. Like you live next door to me, but my house is absolutely nicer, even though it looks the same. And I'm going to sell my house for more. So I think sellers always are in denial for a period of time, and they'll still try to list houses at these higher prices. But I think we're going to start to see, like you said, because of where housing affordability is, these prices are going to drop off. CoreLogic was saying that they think prices are going to come down about 25%. I don't know for sure. And even if we are at peak inflation, think about this. I'm at the peak, and the market might like that. But how far off the inflation mountain does it really go? Like, what's the new plateau for baseline inflation?
I think
it's going to be higher than 2.5. It's going to be higher than that.
Yeah.
We know that. And we're going to try to look at it for planning purposes through this year and the beginning of next. Hey, when we get back, we want to talk about, the stock market's future ain't what it used to be and why it's very important to your financial planning when you return here on Financial Fitness Friday. We'll be right back.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
How do the richest people in the world invest and protect their families? Richard Rosso and Danny Ratliff's next virtual Lunch and Learn on the truth about life insurance will show you how to ensure your income, minimize your taxes, and protect your real estate. Thursday, May 12th at noon. The most important insurance policy you'll ever own is the one you'll have when you die. Register now for the Truth About Life Insurance Lunch and Learn at realinvestmentadvice.com. The truth about life insurance with Ratliff and Rosso. Realinvestmentadvice.com.
Do you know what you don't know when hiring and retaining quality employees? Compensation is more than just wages. It's personal time off, the vacation days, healthcare benefits, a 401k. Do you know what's important to them? Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Let us show you how to make the most of an affordable, effective package that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
Anyone can sell you insurance, and they'll gladly take your premium dollars. The RIA Insurance Agency can provide you with insurance solutions tailor-made for your needs and lifestyle. Because everyone's assets are different, let RIA Insurance review what you need to protect and how. We won't sell you insurance, but what you need will be a matter of policy. RIA Insurance Agency. 888-915-0780. 888-915-0780. RealInvestmentAdvice.com. Click on the Insurance tab.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
There is a trail of tears. I'm like a little girl. On Reddit boards. Because the stocks that were working that made 20-somethings look like market mavens now make them look like toilet scrubbers. And not that there's anything wrong. I love a good scrub toilet. Just not with my money. And these high recent returns. This is a great article by Jason Zweig in the Wall Street Journal if you haven't seen it. And it's called The Stock Market's Future Ain't What It Used to Be. And the reason it resonated with me and resonated with us is if you're getting your financial planning done today, it's a program. It comes out of a box, and then the box, people start planning. They don't look at the internal data. They are using historical returns. And as Jason writes in this piece, high recent returns make you feel rich because they allow you to extrapolate future gains, but you're just borrowing them from the future. So if I have a financial plan today and I say a typical 60-40 portfolio is going to give you 8 to 9% over the next 10 to 12 years, and you're looking to retire this year, well, everything's coming up roses. And then I start taking distributions next year, and I just didn't exactly get 8%. Maybe I'm flat and I've taken 4%. Now I'm in the hole. And the longer I stay in that hole, exponentially the faster it digs into my capital and the better chance I have of outliving my money. So when it comes to this, in this article, Danny, this talking about, hey, stock returns and bond returns are going to be much more of a challenge. Mistakes are going to be rougher. So what was, listen, bull markets cover up a lot of financial mistakes. Now the tide's going to be out maybe. And it doesn't mean it's going to be a bear market, but a tougher market. And when that tide out for you in retirement means more than you think for someone who's 30 years old and can recover. So they're talking about, maybe you get 2 to 4% on your typical portfolio. And if you're not planning for that intelligently in your plan to retire, you really could be setting yourself up from disappointment. And you know what? A lot of advisors use backward-looking returns to create plans, not forward. Listen, it's math, it's valuations. Your firm could do it if they want to. They can change that data. What if they're wrong? Big deal, right, Danny? Guess what? You have more money to spend. I was more conservative based on valuations. I would rather have that discussion with you than you're 5 years into retirement and, hey, what are you planning to do for work? Because you're going to run out of money once the realized returns hit that plan. What are your thoughts?
I love how we always want to look at past returns for future results, and we know that that's not something you can do. In fact, if you look at most mainstream financial media or
they tell you that, right?
Big firms out there, yeah, it's going to be in fine print at the bottom, or they're going to have actually a little bigger box so you can actually see it. But I always look back and think about the years before 2019, after 2008. It was really difficult to find returns in a lot of areas. In fact,
that's right.
Websites for a lot of mutual funds were making it more difficult for you to even find out what those returns were. They'd have a performance tab, but good luck. You'd have to click like 3 other ways to get through to it and actually find what the returns were. Now, once 2008 fell off the books, it was everywhere. Yeah, and these returns looked so much better. And so I always take these things with a grain of salt, and really you have to understand, and like you mentioned, it is a function of math. It is something that, when you think about where we are today, are markets expensive or are they cheap? Where are we? Do we have a headwind? Do we have a tailwind? Mm-hmm. And this is really important. Now we have something we haven't seen in quite a while, inflation.
Yes.
And now this is something else that we have to be mindful of because it's going to erode your capital over time. Now, this inflation, I know the Fed says it's not transitory. It's now we see some permanent aspects. And yeah, there's going to be some of that. But all of this is always transitory. It's always a moving target. And I think, you mentioned something interesting in the sense of what's that new number? 2% was the magic number that we needed to be at for inflation over the last decade. And we struggled to get there. Now, where is it? Because he's fallen back, and Jerome Powell's mentioned once again that 2% number. And I don't know if that's going to be accurate. It's probably going to be a little bit higher.
I mean, even in our planning software, we have revised the baseline to 2.5. Every goal has its own specific inflation, but we start from that baseline. And then what's funny is the creators of the software actually met our baseline like a year and a half after we did it. So that was sort of funny. Hey, do you know how I know that Danny and I haven't done laundry?
How do you know?
We're both wearing our black RAA shirts today as opposed to the blue ones.
Yeah. Nice.
Yeah.
Yeah, bowling league was canceled.
So your financial plan has to be mired in reality, not historical fantasy. And if your advisor is telling you that everything's coming up roses over the next 10 to 12 years with valuations at 40 times earnings and a hostile Fed, that's not going to bode well for what could happen or the surprises that can occur. So and it's just not pessimistic planning. I had one person that came to me with their plan from a brokerage firm the other day, and I ran ours, and it was way different. And he brings it back to his other broker, and you know what his broker says? Those guys are always bearish. Those guys, they don't know what they're doing. They're bearish. This plan, my plan that shows you 11% return is just hunky-dory. And I'm like, well.
Why is that? Why would you not want to say?
Because if I'm of a broker, I'm actually in love. I'm not in love with the client. I'm in love with stocks. I'm in love with the market always goes up. I'm in love with the accumulation mindset when I'm got a person who's no longer Tim Allen, he's Wilson, and he's got to go on the other side of the fence. But the broker doesn't go on the other side of the fence, Danny, and understand the distribution analysis is totally different. But do you know the guy's coming to us? Because he goes, you show me the background of how you created these numbers. This person just said they took the past. And I rather err on the side of reality. He didn't say on the side of conservative. He said on the side of reality. And I wanted to hug him. It would have been odd because we just met a couple of times. So, I got to wait till at least the fourth meeting to hug him. That's my rule. The four meeting hug rule. Have you heard of that, Brian?
Yes, I have.
Oh,
yeah.
Okay, great. He's still doing that at home. So you've got to make sure that this lines up with where the road has changed. The terrain has changed. Your plan must change. You mentioned about inflation, Danny. Even how you might handle, even if your plan makes it. I just read a report yesterday, and I wrote a blog post, I guess about a month and a half ago, about the return to work, that more older Americans are looking to go back into the workforce because inflation is so uncomfortable for them, because the market has been volatile, that they are looking to return to work in some form. With inflation the way it is, plans are going to change outside the numbers that we don't even know about yet, do we?
No, not at all. And I think that the inflationary aspect is something that we probably in some ways get a little bit aggressive on in the sense that we say that people give themselves a pay raise each and every year, which we historically don't see that. But
you might see it now.
Well,
but
yeah, you may
in the
have
past.
to.
Yep.
Shoot, we Michelle went to the store. She came back with some bacon. $10. $10.
$10 for a package of bacon?
That's what she said.
Better be good bacon.
Darn right.
I'll tell you, it's really...
Kids were grabbing at handfuls. Whoa. That's not your allocation.
$10. Hey, wait a minute. You've already taken like $12 worth, buddy.
Yeah,
bacon rationing at the Ratliffs.
Say that 5 times fast.
Yeah, I don't think we don't eat bacon frequently, but it's going to
But
be
it
a little
is
bit less
noticeable.
frequent.
Listen, and people who make good incomes, it's uncomfortable. Can you imagine 80% of Americans that now have to make this decision to say, I can't buy this bacon or I can't buy this particular item because it's out of my pricing at this point. That's why I did an interview yesterday. People feel financially distressed even though their wages have gone up. Yeah, but their wages have not gone up. What prices have gone up? And there's only so long that the economy can handle the prospect of that. So financial distress is here to stay. Even if, like you said, Danny, inflation has plateaued. Well, anybody selling anything has this endowment bias. If I'm selling a used car, if I'm selling anything, I'm still going to try to get this higher price. And I'm going to wait and see if I get it. Like reality is going to take a little bit of time to hit me that how come I was selling cars like this in 2 days and now it's taken 14 days. We don't change that concept, that aspect of things psychologically very quickly. But households can turn on a dime when it comes to, hey, I'm not spending on that anymore. I'm spending on this. You know, like we talk about, look at Netflix. Netflix is down again, I think in the pre-market, another 5%. It's down 35. It's down 40%. Valuations or not, changes in lifestyle where people want to get out or not, that's one of the first things I'm going to cut in my budget before anything else. I am going to cut these streaming services. I don't even care if the content's good because it's $15 a month. Right?
Yeah, it all adds up. And that's the problem now is that many people have, we've talked about how maybe they should start bundling again these other packages because you add them all up, you may be spending just as much or more than what you were spending previously.
If Netflix was going to raise prices, they should have been more aggressive during the pandemic. That's when they would have gotten it. They would have been able to have that kind of pricing power. If they would have went to $19 a month during the pandemic, people would have moaned, but they would have paid. We get back the Secure Act 2.0 about retirement. How's it going to change it for you? When we get back. See you soon.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
How do the richest people of the world invest and protect their families? Richard Rosso and Danny Ratliff's next virtual Lunch and Learn on the truth about life insurance will show you how to insure your income, minimize your taxes, and protect your real estate. Thursday, May 12th at noon. The most important insurance policy you'll ever own is the one you'll have when you die. Register now for the Truth About Life Insurance Lunch and Learn at realinvestmentadvice.com. The truth about life insurance with Ratliff and Rosso. realinvestmentadvice.com.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Our oldest daughter, every time she starts feeling bad, she starts going to Google and finding out what's wrong with herself. And, she comes downstairs, she goes, "Mom, I've got dysentery." "What do you mean you have dysentery?" "Well, I have a fever, I'm nauseated, I've got cramps." It's like, no, that's you're
The Real Investment Show podcast. Same show, your schedule.
Sometimes access to too much information is not really a great thing either.
At realinvestmentadvice.com.
Anyone can sell you insurance, and they'll gladly take your premium dollars. The RIA Insurance Agency can provide you with insurance solutions tailor-made for your needs and lifestyle. Because everyone's assets are different, let RIA Insurance review what you need to protect and how. We won't sell you insurance, but what you need will be a matter of policy. RIA Insurance Agency. 888-915-0780. 888-915-0780. RealInvestmentAdvice.com. Click on the insurance tab.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The most important insurance policy you'll ever own is the one you'll have when you die. Richard Rosso and Danny Ratliff's next virtual Lunch and Learn on the truth about life insurance will show you how to insure your income and protect your real estate. Thursday, May 12th at noon. Register now for the truth about life insurance at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back. Danny surprised me this morning.
How's that?
He usually eats all kind of green stuff in his house, not bacon. Like, what is it, seaweed bacon?
Seaweed bacon. Oh, man. It's kale bacon.
Kale. I forgot what bacon tastes like.
Really?
Sadly.
Been that long?
Yeah, it's been that long. Not that I want it to be that long. It just is.
It's a sad day in the
It really
Rosso
is,
household,
yeah.
man.
I'll tell you, don't
Quite
come eat
deprived.
in my house. I eat like a prisoner in a gulag. Here's your gruel, sir.
Oh, kids come over to our house and they're like, "Hey, where's the food? Snacks?" We're like, we got plenty of it. Apples, bananas, carrots, broccoli.
My brother comes over to my house, goes straight to the refrigerator, opens both doors, and just starts grazing.
Even with the doors open.
Yeah.
Yeah.
It's like the barn doors open.
So, hey, what you got in here?
Nothing. Get out. I knew
you
you
know
were
what?
coming.
I bet Brent looks at a broccoli stalk the way my dog Rosie does.
Yes.
He just goes, she goes,
But I like broccoli.
You do?
Oh yeah.
And butter and cheese.
And butter, or coated with olive oil, a little that pink salt, Himalayan salt.
Yep.
That's what
and then bake them.
You
had to
blew
rub
it
it
on
in there,
that
didn't you?
part, but everything else was healthy there.
Bake them, not bacon.
Oh, I thought you said bacon.
Bake them.
He's going to be thinking about bacon all day.
I know.
It's going to be great.
Yep.
Yeah. Plant-based bacon.
It's going to get him a bacon Whataburger for lunch.
Oh, man, I wish I could do that. Inside, I'm 600 pounds, I'm telling you. So Saturday, April 30th, 9 to 11 a.m., we're going to be in Austin. I'll have hives, but we'll be in Austin at the Renaissance Hotel. And this is our Combating Inflation in Retirement boot camp. Better than anything else. We're going to talk about, it's our soup to nuts class about how to really handle retirement in the face of the kinds of inflation that we're going through right now. So we've got quite a few people signed up. It's from 9 to 11, and this is live event in Austin. So if you all want to take a nice drive, check out the little mini Buc-ee's on the way. I always stop there. And the girl behind the counter goes, "That New York guy's here again." Listen, I'm living here for 23 years. Can I be adopted? But that's the littlest Buc-ee's.
Is it really?
The one in, what is it? In Giddings.
No, not the Giddings. Yeah.
Yeah, that's a tiny one.
That's a tiny Buc-ee's. Did you see they're expanding the Buc-ee's in Luling?
Yeah.
Really?
Yeah, they're creating a whole new area I can work in 10 years.
Richard's Buc-ee's retirement planning.
My girlfriend looks at me like, he's really serious about this Buc-ee's thing. And I'm like, yeah, I am. It's a different perspective, man. The beaver is everything. So it's the Secure Act 2.0. All these iterations over the last few years, they're like all these Terminator movies, right? After a while, you don't give a screw or a nut because it's the same theme. Minor tweaks. So the first Strong Retirement Act, Securing a Strong Retirement Act, was back in 2019. Now we have HR 2954. And I have a feeling, Danny, we're going to see Secure Act 3.0, 4.0, and all that. But here's what I think. See what you think about it. We got a blog post that'll come out next couple of weeks with the highs and lows, positives and negatives for this. There's two words to this new Secure Act that actually make me feel good. One, Rothification. Two, annuitization. Mm-hmm. All of a sudden, Roth was the enemy, Danny. Remember? Roth was this big enemy, but we were saying, listen, it's the J.G. Wentworth of accounts. The government gets cash now. They just can't do it. They're not going to do it. And this act actually bolsters.
Yeah, this is actually rather impressive in the sense that for all of you out there who've been really so concerned, and we hear about this very frequently, that the Roth is going away. This is vindication that it's probably going to stick around here for a bit. So lots of big changes within this. I think the big one that at least grabs most of the headlines is changing the RMD, required minimum distribution age, meaning the age you must start taking funds out of your retirement accounts from 72 to 75. And that'll be over a number of years. They're going to phase that in. But the big thing, what you're talking about, Rich, that I think is much bigger, but it seems to not get any of the headlines, is the ability to, number one, for, catch-up provisions have historically been $1,000. They're going to increase that substantially, or excuse me, well, it's been $6,500 on that. I'm thinking about HSAs, my favorite account. Retirement accounts have historically been $6,500. And they're going to raise that to $10,000. So that's a pretty nice thing. But they're also going to start allowing for, employer contributions to change and actually make those automatic, but then allow them to have those contributions, those catch-up provisions, go to Roth. And the matching contributions go to Roth.
Right.
Which I think is going to be fantastic.
Yeah, I think so, but this is not one of my favorites, and I'll tell you. The catch-up limits, they're going to raise the catch-up limits for simple plans would be raised to $5,000 from $3,000. That's cool.
Yeah.
Now they're going to increase it to $10,000, but let me tell you, it's for very magical ages. You got to be 62, 63, and 64.
Correct.
Why? what's so magical about raising my catch-up contributions to my retirement plans to $10,000?
Well, and why not do that at 50 like everything else?
Yeah, there's some things I do not understand why they make unnecessarily complicated. It makes no sense. So I don't know, but here's the positive, as Danny's talking about. Beginning in January 2023, there would be required to be Roth options, such as Roth 403B, right? You're going to have simple plan Roth options, SEP plan Roth options. And like you said, I could put my catch-ups in Roth, where Roth wasn't even, it makes me think, I wonder how many companies don't have Roth 401k that are going to need to get on the bandwagon to get them.
Well, I think there's a lot. I mean, think about all the plans that are out there that have never been changed. What a lot of people don't even realize is that they do have the ability to contribute to Roth, but they don't do it because it's hidden behind the wall or they don't see it.
Or the company doesn't have it.
Yeah.
But now you're going to hear a lot more discussion. Don't you see in mainstream media, financial media, they talk about Roth a lot more, which we've been doing for a while.
Yeah,
now,
they announced that tax bill. It got real popular.
It really did, yeah. The Secure Act 2 raises, to Danny's point, the RMD age, required minimum distribution age 75. But again, the path to get there makes absolutely no sense. So 2023, your RMD age would be 73 for those who reach 72 after December 2022. 74 in 2030, 75 in 2033. Why? Why is this all this complication with stair-stepping this thing? I'm hoping that once this if this bill goes through, and it looks like it will, they remove these speed bumps and get you to 75 on a simpler path. I don't understand throwing all of this stuff in to confuse everybody. Is it just to make the act add more pages to it? Is it an administrative thing?
Yeah, where was the magic number? What type of research was done to actually figure that instead of doing just say, hey, all catch-up provisions are going to be at this amount, we're going to make that at 62, 63, 64.
Yeah.
Makes no sense whatsoever. But Rich, the other aspect of all these things, it's like, okay, great, you increase the required minimum distribution age. Most people are dipping into it way before then anyways. I mean, that's good for a handful of people, but that shouldn't be the headline.
Yeah, like you said, a lot of people don't. There's so many points of leakage in a retirement plan to take money. Most people are, but it's nice to know that maybe you have the choice. But here's what's really cool: if I postpone my RMDs, Danny, say my RMDs postponed to 75, then obviously I can be more aggressive with my Roth conversions for longer. That's a good thing, right? Because I can't convert my RMD. But if I'm on this surgical Roth RMD train, which is what Danny and I talk about a lot, and our planners do here, then I've got a window that used to close on me earlier that I can continue my Roth conversions. Money that would have been going into RMD could go to Roth. And I think that's a positive. The stair-stepping to get there doesn't make any sense to me, but we'll see how that works. Now, there's going to be expanded automatic enrollment in retirement plans. So there are multiple studies about how humans do better when they are nudged in the right direction. In other words, if they're given a choice to opt in or opt out, most people have a difficult time taking action to opt in. And then they rarely opt out, especially if the decision benefits them. So in the case of auto enrollment, the success has worked. Mm-hmm. And now what they're going to say is that every year auto enrollments would increase by
1% up to 10%, right?
Right. So it would be start at 3%, then 1% a year up to 10%, unless the participant elects not to have such contributions taken. But I will tell you, we say this all the time. We tell people, dial the notch, the dial, move it higher for your retirement deferrals, to your plan. You won't even notice it. But here the company is just going to do it. And I actually think this is a positive, even though I think, why do we have to tell grown adults? Why can't they do it on their own? But we've obviously seen, based on financial literacy in this country, it makes sense for us to sort of force feed you into these contributions.
Rich, it's just like that 62, 63, 64. I just figured out, just a light bulb went off. Oh. The average retiree age is 62. So they say, hey, nobody's going to use this. It won't matter.
We get back, we're going to continue on the Secure Act 2.0. We'll be back.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
How do the richest people in the world invest and protect their families? Richard Rosso and Danny Ratliff's next virtual Lunch and Learn on the truth about life insurance will show you how to insure your income, minimize your taxes, and protect your real estate. Thursday, May 12th at noon. The most important insurance policy you'll ever own is the one you'll have when you die. Register now for the truth about life insurance Lunch and Learn at realinvestmentadvice.com. The truth about life insurance with Ratliff and Rosso. Realinvestmentadvice.com.
What worries you about your money? Enhance your financial success with RIA Advisors' free financial planning tool, MyBlocks. It's our online modular manager for your money and your life. Does your vision of retirement match up to reality? MyBlocks can help to determine how much you'll need and how you can achieve. Create your own personal financial vision for the next decade with MyBlocks, our free tool at RIAadvisors.com. Click on the Client Portal tab, RIAadvisors.com.
Anyone can sell you insurance, and they'll gladly take your premium dollars. The RIA Insurance Agency can provide you with insurance solutions tailor-made for your needs and lifestyle. Because everyone's assets are different, let RIA Insurance review what you need to protect and how. We won't sell you insurance, but what you need will be a matter of policy. RIA Insurance Agency. 888-915-0780. 888-915-0780. RealInvestmentAdvice.com. Click on the Insurance tab.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors. 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Did you know a large group of Karens is called a homeowners association? I bet you didn't.
That makes perfect sense.
What's the male equivalent to Karen? I heard it was Dave. They said it's Dave. Is that true?
I'm sensing more like a Bruce.
That's what Bruce sounds better.
Yeah.
Not Dave. Dave sounds a little too cool.
Yeah.
Bruce. Whitley. Blake.
His name is Ken.
Blake, absolutely.
Ken.
It's Ken.
Yes.
That's it. That's Ken. Ken and Karen.
Kens and Karens.
Oh, the Kens and Karens.
Paradise in suburbia.
How much gray hair do I have because of you people? So this Secure Act, again, we don't know when this is going to go through. I don't see any reason why it wouldn't. So I've been hesitant to write anything about it because it will change, but you should know about it. So they're also looking to do in this act is bolster the savers credit. So this is, what a tax credit's great. That's a dollar for dollar reduction in your tax liability. Much more powerful than a deduction. So for lower income households saving for retirement, this bill increases that credit to 50%. And it removes the provision that decreases the credit as income increases. And the bar has been lowered so more households can receive the credit. I don't know if this credit is going to get more people to participate in their long-term plans, okay? Currently, there is the savers credit. It's not talked about a lot, but there is a taxpayer can claim the credit for 50%, 20%, 10% of the first $2,000 that's contributed during the year to a retirement account. It's something. Tax credit is not something I would throw away, but I don't think a lot of people know about it. They have to be told about it. So I think part of the act is also to improve the communication around this particular situation overall. Now, here's the one I really like, Danny. The preservation of income in Title II. This bill finally embraces guaranteed income options in retirement plans. See, I find this greatly encouraging overall. So some of the barriers to lifetime income options in employer plans like 401ks are being removed. There's more of a discussion of the importance of some form of annuity structure or guaranteed income structure to create your own pension to complement your Social Security. A lot of people listening to this show probably don't need it. Most Americans are going to need some form of guaranteed income structure because they're not saving enough for retirement. So having the ability to have the longevity risk looked at and taken care of through your 401k, I really do think is a positive. So they're looking at the fiduciary standard, how they can incorporate the record keeping, the portability. So if you do have an income option, you can move it to another employer. I mean, again, I don't know where this overall goes. There's a lot of work that needs to go into this, but the discussion is starting about most people are going to be in trouble without some form of guaranteed or check in the mail every month. And this gets us started on that path.
Well, I think this will be really nice as well, because then you can, participants can begin to start thinking about being a little more strategic as far as where they're placing funds, looking at a bigger picture from a financial planning perspective of saying, okay, how does this work from that longevity perspective? What if I have this income? Within a plan, we love to have guaranteed income for your non-discretionary expenses, just to make sure that, hey, you meet your bottom line, right? Roof over your head, you're fed, you're clothed, everybody's healthy and well. And then from there, everything else is icing on the cake. And historically, we don't see that anymore. It used to be way back in the day. It's been, everybody had the pension. Everybody had, the savings. Now, as things have been crunched over the years, I think this will be a really nice kind of feather in the cap for those retirement plans.
Yes, as my professor mentor Z. Bodie would say, it's retirement nirvana. If I have all my needs covered by income that doesn't fluctuate and I cannot outlive. And we used to have this three-part stool, right, of pension and Social Security and savings. And obviously, it's a very wobbly stool because pensions are not there. So there's got to be a way for people to have this option and Danny, most important, how to get educated on this option. Because I think that's going to be a big place for, say, 401k providers. They're going to have to provide quite a bit of education on how to use these. And guess what? This whole industry doesn't like insurance. So I'm trying to figure out how a 401k provider that thinks that stocks and bonds sort of walk on water are now going to have to help you look at things more academically and functionally in real life using these products. So that's going to be an interesting kind of twist to the Terminator movie.
Well, retirement
Is the robot really a robot?
Yeah. Right? Retirement plan advisors are going to have to step it up, right? I mean, this is a problem right now. It's been easy because your qualified deferred option is going to be an age-based portfolio. There's not a ton of options in a lot of these plans. Now all of a sudden you're going to have access to something that has never been there before that people aren't really up to speed on. I think
they're not up to not up to speed on, and nor they have a bias toward, right? So you're going to have to remove the bias and look at it like the reality of somebody's situation.
But let's face it. I mean, most of these plans, they're not changed often. They're not looked at from a pricing perspective. So people may be paying way too much, or outgrow a current plan. I mean, we see that often. That's why we have Tom Allen, our retirement plan consultant, who deals strictly with retirement plans for businesses. And this is great because, when you're trying to navigate all these things, it's extremely difficult. And so I think that, Rich, maybe you have a lot of plans that opt out of it, unless they're going to be force-fed. And they're going to say, this is going to be a mandatory part of these plans.
That's the point.
I think a lot of them just don't even cover it because it's going to take a lot of money and time with training. You're going to have to, like you said, you have to change a lot of minds here. And not only training just for the employees, but the people who who are producing the plans.
Yeah, and listen, I only have one love, and that's stocks, because stocks do everything. Stocks are like the answer to when anybody asks me a question, all I say, stock market. Brent, what would you like for lunch today? Brent asked me. I said, stock market. It's, broaden your horizons. And to your point, will some plans say we're not going to bother? I don't know, Danny. That's a very good point. I'm not sure overall. Now, there also is this matching contributions for qualified student loan payments. So think about this way. You're a younger worker. You're saddled with student loan debt. You have to make this decision. Pay my debt, contribute to my retirement plan, buy retirement plan. I'm going to do this. Well, with this proposal in Secure Act 2.0, an employee can receive matching contributions, most likely 3%, to a retirement plan, even though they're not contributing because they're paying a student loan. So usually for you to get a match, you have to contribute to your retirement plan. What they're saying in this act is, well, if you are paying toward a qualified student loan, and we see that, then we're going to give you the elective deferral as the company. We're going to give you that and put it away. You didn't put money into it, but we're going to do it. So we're going to help you save for your retirement while you are paying off student loan debt. I'm sort of torn by this one, Danny, because I'm old school that how did you get to this loan? How do you not pay it off? I mean, again, we're not going to get into that, but it's a provision. It's a reality, and the Secure Act 2.0 is looking on how to tackle it so that younger workers are going to have to, at least are getting some money put away in their retirement plans. So that's the overall gist of it. So 2 words, Rothification, annuitization, and we're going to see how this all works out. And to your point, Danny, the annuitization part, the life income options, that to me, to your point, is going to be very interesting to see how that's incorporated, how it's accepted, how the message is delivered. Man, that I feel like that's going to be like 10 blog posts on the challenges there. But I do think overall, I'm giving the Secure Act a C+. And the only reason I'm doing that is this 2.0 is because of all the complications they're throwing in with ages. But it's a step in the right direction.
Well, Rich, the problem here is that they tried the Secure Act 2.0 should be like 5.0 because we've gone through several iterations of it just last year, multiple times. They tried to get this passed. House could get it passed, Senate couldn't, or the House Ways and Means Committee, they really liked something, but could never really get the traction on it. I think that they're probably needing to do something here domestically right now. We've heard about higher taxes. I think that's DOA. There's not going to be a whole lot moving with that, at least at the moment. We'll see. I mean, these are all things that they need to do in an election year to say, hey, we're doing things to help bolster consumers and all of our constituents that you can do more, have more kind of a safety net and have more flexibility. And I think that's going to be a good thing in that aspect. But we'll see what gets done and what does it actually look like. I would love, like you said, take that provision out where it's not 62, 63, 64. You can actually do this much, much sooner. On the YouTube channel in their comments today, TS mentioned, well, maybe they're utilizing this so you can put funds towards a Roth in your contribution and take Social Security early, which that could be a one avenue, but you would be subject to the earnings test, right?
Yeah.
And but benefits potentially withheld, not only in locking in a permanent discount,
but it could foster Roth conversion, which gives it does expand the J.G. Wentworth concept of I'm getting my money now as the government. So Peter Thiel, we don't hate you anymore. We don't even know you exist, per the government, because we still like Roth, as Danny and I have said. Roth's not going away. It gets the government their cash now. Hey, that's it for Financial Fitness Friday. Thank you for all the engagement on YouTube. We love you guys, and thanks for listening. We'll see you next week. Have a great weekend, everyone. Lance on Monday.
It's a rich man.